Good morning, good afternoon. My name is Stephen Winokur. I'm the Chief Marketing Officer here at Angel Oak. Today we are joined by two of the top AEs, not only within Angel Oak, but within the country. This would be a real treat to have both Eric and Stacy on today. So let's get, before we get going to them, just real quick, a little bit of housekeeping. This webinar is being recorded. The recording will be sent out tomorrow. And you can always find all of our webinar recordings on our blog, either at the link you see on the screen or on our website. Simply go hit the blog button. Along the right-hand side, you will see a term that says webinars. Click that and you'll see all of our deep dive webinars for the past couple of years. So they're all there waiting for you. So without further ado, let me introduce our esteemed panelists. Stacy, you want to go ahead and introduce yourself?
Hi, thank you. I appreciate it. My name's Stacy Flanigan. I'm the Senior Account Executive in the Tampa Bay area of Florida. So I've been with Angel Oak since the end of 2013 and so happy to be here and be talking to you guys.
Eric, go ahead.
Eric Morgenson. I am out here in Southern California. I've been with Angel Oak going on 9 years, been focused on this non-agency programs, and just happy to be a part of this.
Excellent. Thank you both. Real quick, before we get started, I just wanted to make a quick comment. I was just recently at the Housing Wire annual conference out in Scottsdale. And the thing that really struck me was all executives from different lenders. And the thing that really struck me was the positivity that came out of that conference. So we hope you pick up on that a little bit today. Everybody, obviously, you know, this is a tough time in the mortgage business, but everybody felt like this was just a normal cycle. We've all been in this business before. We've all seen the ups and seen the downs. And so the main takeaway I took away from that really was the people that stay the course, continue to communicate, continue to further their business, educate themselves on new programs, new things in the marketplace. Those are the ones that are really going to thrive when the market turns up again. So I'm, congratulate you all for taking the time out of your day to learn a little bit about non-QM. Before we get started, we wanted to launch a quick poll. Who has originated a non-QM loan in the past 12 months? Give it a couple seconds. All right, let's share this. So what do we got? So about 50-50, that's great. We usually find the numbers that people are a little bit lower on the people who have originated a non-QM loan. So that's great news that half of you have. So we'll help you. Stacy and Eric will definitely give you some tips on how to find more borrowers. And for those 51% that haven't, you'll learn some tips as well. So let's jump right in. Stacy, why don't you give us a little bit of information on the type of borrowers that non-QM fits?
So the non-QM is non-qualified mortgage. So anybody that's got a loan that does not fit your conventional Fannie Mae or Freddie Mac loan programs, reach out to your Angel Oak account executive. Let's see if it's something that we can do. Non-QM is your portfolio lending. That's going to be somebody that is self-employed, that needs our bank statement program where we calculate the income using the deposits on the bank statements. We have a no income cash flow loan where it's called the DSCR, which is the debt service coverage ratio loan. This is for investment properties where they don't have to qualify with their income at all. It's going to be based off the cash flow of the property. We have the just missed, somebody that fell out of conventional or FHA due to various reasons. Maybe it's the loan amount or a recent bankruptcy or foreclosure. So that just missed borrower, which also leads me into the next one, which is your credit event borrower. Somebody, again, that had a recent bankruptcy or even a mortgage late, foreclosure, short sale that don't fit within the conventional guidelines. We also have an asset qualifier program, and we'll talk a little bit more about these more in depth as we go on. But this asset qualifier program is somebody that has a lot of assets. Maybe they're retired, or maybe they're a professional athlete that doesn't have 3 years left on their contract, but they have a lot of assets in the bank. So again, they don't have to qualify off their income, just off their assets that they have in the bank. So that's pretty much the portfolio of loans that we do. But again, anything that you get that you do not, cannot get qualified under FHA or conventional methods, definitely reach out to your Angel account rep.
Great, thanks, Stacy. So I have another poll here. Who has actively marketed for these type of borrowers? So we'll run this poll, or do you actively market for these type of borrowers? Give it a couple seconds. All right, let's share the results here. So it looks like it's about a 40-60 split. So 60% of you have said you don't actively market these type of borrowers. And you'll find this webinar extremely useful then. So Eric, let's talk about the opportunity for self-employed borrowers.
Well, as you can see from this graph, look at all the new business applications out there. You guys, we have quite the entrepreneurial spirit here in America, but we have two different tax codes. You have the W-2 tax code over here for folks that really don't take a lot of risk. And over here, you have the self-employed tax code that is incentivized to take risk. You see, our tax code's designed to obviously perpetuate the federal, and in a lot of our cases, the state government, but it's also designed for job creation and investment. You see, when you start a business, you're investing into that business, and if that business pans out, boy, the federal government has a windfall of tax revenue. That's why it's incentivized for it. But never in the history of mortgage banking do we have this perfect storm where we have this huge home appreciation climb, coupled with the ATR regulation standing for the ability to repay the loan, where somebody can document $62,000 to the IRS for personal income, turn around and get a mortgage on $1 million home. Never before has this ever happened, you guys. So with that said, not a lot of people understand bank statement loans, certainly not realtors, and certainly not accountants. So there is just an enormous underserved market out there. You see, these self-employed borrowers can't have it both ways. They can't maximize all their write-offs and still qualify for a loan, can they? Now they can.
Excellent. So before I jump to the next, real quick, if you have any questions, please feel free to enter them into the questions box, and we'll try to get them answered on this webinar. So Stacy, tell us a little bit about what a self-employed borrower looks like.
So the definition of a self-employed borrower is somebody that is obviously self-employed, owns a business, or even 1099 borrowers. If they're 1099 with a company, or even multiple companies, like truck drivers, they may be working for multiple companies as a 1099 employee. Those are going to be your self-employed borrowers. They could maybe own a professional business, a retail, even a house cleaner, car detailer. We get a lot in the salon business, a lot of nail techs that own the company, or the techs themselves are usually 1099. Truckers, I mentioned, realtors are a huge one that benefit from our programs tremendously because, again, they're 1099 borrowers. So they're a great resource. I believe that we have a percentage. I think our highest percentage of self-employed borrowers are in the construction business. And wasn't realtors number 2 or 3, Steve?
Yes, the first one actually was professional services, followed by the real estate professionals.
Okay.
So yes.
So again, these self-employed borrowers, as long as you've been self-employed for the last 2 years or 1099, you can qualify for the bank statement program.
Excellent. So Eric, talk to us a little bit about the program itself.
You guys, it's the biggest speed bump in these non-agency loans. Some people call them non-QM. I like to call them non-agency because literally, these loans don't fall into a qualified, non-qualified realm when it's non-owner occupied. It's just a non-TRID loan. So non-agency is really what it is. And with a bank statement loan, I see a lot of loan officers new in this really stumbling because they're overthinking it. Here's how simplistic this is. Fully bake a 1003. What I mean by that is fill it out completely, including if that borrower is currently renting, what is their monthly rental? We need to know that because one of the 8 pillars of ATR is payment shock. So a completed 1003, a credit report, and either 12 or 24 months bank statements. Give that, just upload it to us, and we're going to fully credit underwrite right up front for you the income and the credit. Now, it's not a full underwrite. We haven't seen the appraisal yet. We haven't seen title yet, but that's a full credit and income underwrite for you right up front, even on a TBD property. The borrower hasn't started shopping yet. We're going to do that for you right up front within 24 hours currently. It's just that simple. Now, the borrower does have to be self-employed for at least 2 years. Not a big hurdle right there. And we love sole proprietors. We're okay with borrowers that are working under a cash business. That's fine with us as well. And I'm telling you, there's millions of borrowers out there that would qualify for a bank statement loan that don't know that these loan programs exist.
Excellent point. So we did get one question in regarding this. Eric, can you tell us a little bit? So the question talks about a person depositing $500,000 a year in deposits on 12 months of statements. How do we calculate the income on that?
So what we're going to do, to answer that, Angel Oak, we've been at this for 9 going on 10 years doing bank statement loans, folks. And let me tell you, 7 years ago, doing a bank statement loan was wonky with Angel Oak and with all my frenemies, my friendly competitors. It was awkward at best. Now we have this down to a science. Any bank statement loan that comes in, we're going to give that borrower a 50% profit margin, 50% right off the bat. And if the DTI works, that means a 50% expense ratio as well. You see, folks, all businesses have expenses, right? If they didn't, you'd go full doc. So we're going to give them a 50% expense ratio. So we're going to, that $500,000, we're going to cut it in half and give them $250 amortized over 12 months. That we want to see the DTI to be 40 front and max 50 back. It's that simple. Now, if you have a borrower that has 150 employees and 7 locations, well, with them, we're going to default on that to a 30% profit margin, meaning a 70% expense ratio, because they have a heck of a lot of overhead. But my point is, the expense ratio here at Angel Oak is very liberal. We make loans work. Now, you mentioned realtors. We give realtors right off the top, we give them 85% of what they deposit into their personal checking account because the broker of record pays them into their personal checking account. 85% to make real estate bank statement loans work. And I'm telling you, once your realtor partners know about these loans and are educated on them, a lot of them are going to be calling you for one of these loans for themselves.
Excellent. So Sam, one of the beauties of working with Angel Oak is you do not have to calculate the income yourself. Like Eric said before, we will do that for you. Stacy, we got a question, super easy one for you. What's the difference between 12 and 24 months bank statements besides the obvious 12 months?
12 months. So honestly, it's up to the borrower. They may have had a really good year this past year, so maybe the most recent 12 months is going to be a better income. There's no difference to the LTV, and there's just a slight difference to rate at the highest LTV. Some of the lowers LTV, there's even no difference to the rate between 12 and 24. Now, if they just opened their business 24 months ago, it took them a year to get going, then maybe the last 12 months is going to be better. What we suggest is send us the 24 months if they're able to provide 24. If they only want to provide 12, that's fine too. But if they want to provide 24, we'll calculate the 24, and us as AEs will say, okay, the income is better branched out over the 24-month average rather than the 12. I can give them more income if I use the 24-month average. So we can decide that after we get the income calculated. And the other great thing about us calculating this income up front on a TBD is you can tell your realtors, hey, you may have thought you could only start showing them houses in the 250 to 300 range based off their tax returns, but now Angel Oak has calculated the income and I got way more buying power. I can start shopping between the $500,000 and $700,000 purchase price marks. So there's a lot more buying power when you take a look at their tax returns versus the deposits that are going into their bank account. It's a big difference 99% of the time. The other thing about the bank statement program is if there's a spouse that's W-2'd, we can use their income as well. I don't want to see tax returns, but we can use their W-2s and pay stubs, which means that we're giving them additional buying power, again, to increase that purchase price on that home.
Excellent. Yep, and you just answered one of the questions. No, tax returns are not required. Yes, Dana, yes, Stacy is one of the account executives in Tampa. So Eric, you want to touch on this one? What about irregular deposits? Like if mass deposits 1 month, less the next, or even zero in the next, how do we handle the regular deposits?
Okay, so everybody on this call, no doubt the NMLS licensed folks have all been tested on ATR, the ability to repay. We all know that every borrower has a 3-year statute of limitation to sue their lender, in this case Angel Oak, for their inability to repay their primary mortgage. Okay, so that's the rules. So now we have a bank statement loan where we have a borrower, let's say a commercial real estate developer that literally has 7 months without deposits, 2 months with moderate deposits, and 3 months with, you know, a $400,000 deposit in 1 month. That irregular, that atypical deposit, it's hard for a lender like us to give somebody a 30-year loan based on 1 good month out of a 12-month bank statement loan. So we're going to look at these literally through the eyes of common sense goggles. We're going to put them on and we're going to approach each loan based on its own merit. Now, we want to see everything about the borrower. We love making exceptions. So what's an exception? A very low debt to income ratio, even though it's a bank statement loan. What's another exception? The borrower has a history of carrying jumbo loans without ever making, without ever missing a payment. So we're looking at the entire picture of every loan. So getting back to atypical deposits, we're going to look at those case by case.
Thank you. Stacy, Jennifer, yes, I agree. Stacy is the bomb. You got a shout out from one of your customers, it looks like, Stacy. So, so let's keep moving here. So, Eric, where do you find these base statement borrowers?
Oh my God, you walk out your front door, you're going to trip over one. So anybody, there's over 1 million strip malls in America. Isn't that an interesting stat? They're all over Southern California. And in these strip malls, there's small businesses from dry cleaners, donut shops. Geez, you go to a local independent pizza restaurant, there is an entrepreneur that's getting it done. Anytime you visit a small business, what's stopping you from going, hey, I specialize in mortgages for self-employed people like you. Are you interested in, number one, home ownership, or you already own a home? Are you interested in buying a bigger house or another house? Bam, right there. There's millions of them out there. Right. Millions. So yeah. Here's my favorite referral source, CPAs. Think about a CPA. CPA, if you're self-employed, rarely are you going to TurboTax and doing your own taxes. You normally have a CPA who's clever about finding all of the write-offs in our 70,000 page tax code, right? So here's a CPA who knows where all the financial bodies are buried with any self-employed borrower out there. And educating CPAs on the fact that these loans are, number one, ATR compliant. But CPAs, they think alt income loans are the cause of that financial meltdown 10 years ago. And oh my God, you people are crazy. Once you educate a CPA on these loans, how we go about calculating the income, the performance of these, we even have marketing for you to market to CPAs. Can you imagine if my CPA said, Eric, you really want to buy that house? We all know how emotional home buying is. You really need to call Stacy if you really want to buy that house, because literally we are maximizing your write-offs. Why pay the federal government more money than you should? Stacy, we can still get all your write-offs, and Stacy can help you get into a new house. Now, am I going to call up Stacy and start grinding around the rate? No. Hey, listen, my accountant, who I trust, told me you could possibly help me buy a house. Guys, can you imagine having 3, 4, maybe 5 CPAs referring their self-employed clients to you for home ownership over the next 2 or 3 years? What's that going to do to your personal checking account? CPAs, oh my gosh. And guess what? Your CPAs are meeting in the county where anybody is sitting right now. There is local CPA associations. Go post up and go meet some CPAs and let them know what you do. Let them know that these bank statement loans exist. Oh, by the way, CPAs love these loans for themselves. When they find out that they can literally get a mortgage and not document hardly any income to the IRS, they're really excited about it. So that's my favorite referral.
Stacy, you want to touch on some of the other ones on here?
Sure. I actually personally had referrals from my financial advisor. He knows what I do. I tell him, exactly what I do, and financial advisors want you to keep your money in the market. So anybody that he comes across that knows can't get a job on the conventional route, he's actually sent me quite a few referrals, and I then, give them out to my brokers as referrals from me. So I think financial advisors, kind of like along with the CPA, is a great resource. The other big one too is builders. So builders have their own in-home financial institution that they have to use. Most of them, they'll only do the vanilla, will only do conventional loans. So when they get a self-employed borrower, somebody that needs to use a bank statement loan, they have to farm these out. If you can get in with builders and become their preferred lender, after, of course, their in-house lender, if you can become their preferred lender outsourced for these portfolio loans, you're going to get a ton of business. Builders, I know in my area, new houses are being destroyed and rebuilt into these monster houses. Builders are so busy right now. Getting in with builders, start off with the smaller builders, keep going up, get your name out there. I know a lot of brokers that do a ton of business with the builder associations. And again, like Eric said, builder associations are having meetings. Pop in there, do it, let them know what you do. Sometimes you can even get up there and do a little 3-minute presentation in front of these people. Another big one too is social media. Social media is the biggest thing right now. My kids say I'm old, so I'm only on Facebook because that's for old people, according to my children. So I know social media is huge right now with the older people, with the younger people. There's so many levels of social media. I've recorded many podcasts for my brokers. They put them on their social media platforms. We'll record 4 or 5 different podcasts in one sitting. It takes us an hour and we're done. And they drop them into these little increments, these quick little did you know, and throw them on their social media. And they're getting great responses. So those are 3 of my favorite ones, is the financial advisors, the builders, and the social media platforms.
Excellent. Eric, I know you talk about this one a lot. This one, to me, when I first started talking to you about it, was always counterintuitive, but why would I talk to other loan officers about non-QM or non-agency?
Here's the thing, you guys. If If any of you folks out there ever worked at a money center bank, and you still have those relationships, as we're on this webinar right now, Chase, B of A, Wells Fargo, even credit unions are saying no to borrowers that come to them with tax returns saying, oh gosh, we don't show enough income. So now what do they need to do? They have to go amend their taxes, possibly tell the IRS, well, I really made this much and I told you I only made this much, and that's painful for the borrower and for the CPA. But they're turning them down. If you know people that are in a position where they don't do these loans and you have access to them, connect the dots. It's that simple. Why would a loan officer that can't do this loan not refer this loan to you and that borrower?
Right.
That's a great point, Eric. I know we have like these little mom and pop shop banks over here in my area, and they only have a window that they lend on. And if you don't fit inside that box, they can't do that loan. You pop in there, leave your business card and a little flyer and say, hey, if you with all the LOs, put it on all the LOs desks in the actual bank. If you can't get it done, call me, I'll help you out. You get to build that relationship with those, and all of a sudden you start getting all their business. And the guy in the cubicle next to him that can't get one done, he looks over and he says, hey, where are you sending your loans that you can't get done? Oh, I'm sending them to Eric Morgenson. All right, perfect. Give me his number. Let me start sending them over there as well. You know, it becomes a relationship. They know that they can trust you guys as their other broker, that they can send other loans to that they can't get done. And all of a sudden you start building up your business.
Excellent point. Stacy, we had a quick question. What about a loan officer that's been paid by 1099 for 6 years? Is that a good candidate for the bank statement program?
Yeah, we can do any 1099 borrowers as long as they've been 1099 for 2 years on the bank statement program. So the key is to be 1099 for 2 years. A lot of times you'll see employers too, where they were W-2'd and the employers changed the borrower status to a 1099 because they didn't want to pay their insurance or whatever the case may be. And they could still be working with the same company that they used to be W-2'd with, but have now switched to a 1099.
Excellent. Ken, we're going to get to that. We do have marketing flyers. We're going to hit that in a little bit. Go through that a little bit later. So Eric, tell us a little bit about opportunity for investment properties, investment loans.
Well, everybody, we all know that, boy, this market has changed a little bit, huh? And with that said, a lot of your competition are leaving the industry, you guys. And that's a fact. However, with that said, there are still people buying homes, both investment and owner occupied, and there are still folks that want to access the equity in their property. That is not changing. The question is, who are they going to do that with? Why not you? When it comes to investment properties, you guys, look at the appetite out there in America still wanting to gobble up all these investment properties. There's a lot of foreign nationals, you guys. The world is a crazy place right now. And but everybody has seen the market in America, residential real estate, do this. And guess what? It's got the world's attention. So everybody literally is kind of smart money is chasing investment properties. So in California, investment properties, it's a weird market versus the rest of the nation. Same with New York and let's say Boston. The real estate is so expensive that on an investment property on a no-doc loan, it's hard to debt service cover. So with that said, we want to see, our current guidelines want to see the property at least 1-to-1 debt service cover. Now, guidelines have been drawn back a little bit because of the 2-year swap and the market changes. But we believe we're going to get back to business as usual soon enough. But there are a lot of investors out there that are trying to buy investment property. And if I'm 10 or more, if I have 10 or more investment properties, I can't go agency. Fannie taps out at 10, Freddie Mac taps out at 5. So now what are my options? Well, I can go get some hard money loans. Well, hard money loans are very expensive, 2 points over the head, and then you guys charge a point as a loan officer. There's a possible 3-point origination, and hard money loans are normally a 2 or a 1-year balloon. Hard money lenders usually tap out at 65% LTV, and hard money lending right now, I've seen it go from 9% now up to 14% interest. With our loans with a DSCR, it is a 30-year fix. We have a 40-year IO option. With that said, we can go to 75% LTV. The interest rate is a lot lower than using hard money. And we allow cash out on these, obviously, in purchase. So there is still a big appetite out there. The question is, who are those potential investment property buyers? Who are they going to work with? Why not you?
So you jumped a little bit ahead on us, Eric, but Stacy, you want to hit like some of the high points of the our investor cash flow program that Eric didn't just hit?
Yeah, Eric is that good. He just did it for me. So there is a 4-year seasoning on foreclosures, short sales, deed in lieu. You don't want to see any employment or income on the 1003. You're going to leave that blank. Don't want to see income, don't want to see employment, don't care what they do. They could be retired, who cares? You're going to leave that blank. So the debt service coverage ratio is basically the market rent on the appraisal has to cover, like Eric said, your new PITIA, if they have HOA, PITIA payment 1-to-1. So as a smart investor, more than likely you're going to purchase a property that does get covered by your rental. You as an investor, you're going to want the market rent to cover your new payment, at least cover your new payment. So if your PITIA payment is $1,200 a month, your market rent on the appraisal comes in at $1,200 or higher, you're good to go. 25% down, you don't need any income, you don't need any tax returns, you don't need any employment, and your market rent is going to cover your mortgage payment. I mean, that's a pretty darn good program. So no limit on the number of properties they own. So like Eric said, when you go Fannie or Freddie, you have a limitation on how many properties you can own. This program, there is none. They can own 50, 100, 150 properties, does not matter. There is no DTI, remember. They must have a primary residence. The reason being is Dodd-Frank says we can't do a no-doc loan on an investment property. So one of the ways that we verify that that this is going to be an investment property and they're not going to be moving into it is that they own a primary residence. So us as AEs, when we get the pre-qual, the first thing I jump on is Zillow or Realtor.com, make sure they own a primary and that it's not listed for sale. If it's listed for sale, that's going to tell me that they're probably going to be moving into this new property. We don't want any occupancy concerns once it gets to underwriting. So I'm going to do that, and the AE is going to do that at the pre-approval, at the pre-qual stage. So we're going to look at it, make sure they own a primary. If they don't own a primary, but they're a heavily invested investor, they own 15 properties, but they live with their fiance, they rent. That is something that we would consider, even though they technically don't own a primary, but because they have all these other investment properties, again, like Eric said, most of our loans do have exceptions on them. That would be one that would make sense. So we're going to look at that. The other great thing about this, and any investment property, whether you're going full doc or bank statement, you can close in an LLC. A lot of investors want to close in an LLC. You don't have to have that LLC seasoned for any length of time. They can create it today and close in it tomorrow. Anyone that's on the LLC does have to be on the loan, and that's going to be a max of 2 people. So those are some highlights. The other big highlight for me with any program, again, is delayed financing. If a borrower purchases a property because there's 5 backup offers, or the seller's going to say, oh, I'm going to keep your EMD if you don't close by this time, I got to purchase it right away, and they purchase it cash or even with a hard money lender just to get the home so they don't lose it, we can turn around and do a refinance based as a purchase, meaning I'm going to source where they got the funds, make sure they were the borrower's own funds when they purchased it, but we can turn around and recoup their cash to them the day after, as quickly as the day after closing. So that's another great opportunity that we have as Angel Oak, being able to do that delayed financing and not hit them for cash out to the rate or to the LTV. I'm going to treat the LTV and the rate as if it was a purchase.
Excellent. Eric, got an easy one for you. How many units will we go up to on this program?
We're 1 to 4. We're 100% resi. We'll do high-rise condos. We don't do condotels. We're 100% residential lender out there. We don't do any commercial lending. Stick to our lane.
And then can you close in a corporation, not an LLC?
No, not a corporation. Yeah, corporations are completely different than limited liability corporations. So a C Corp, S Corp, no, that now makes it a commercial loan, and these are what are known as full recourse loans. That is a borrower that's looking for a non-recourse loan, so they would be best suited to go to a commercial lender.
Okay. Stacy, what about short-term rentals? Can you qualify on this program if you have one of those?
Yeah, so we don't care what the borrower does with the property once they purchase it. If they want to Airbnb it, VRBO it, that's totally fine. So when they purchase the property, we're going to use the market rent off the appraisal. Now, the seller may have Airbnb'd it or VRBO'd it. They can get a P&L from Airbnb, for example, and give it to the AMC and ask them to give it to the appraiser to help them with the market rent, because a lot of times appraisers may get lazy on looking up market rents around the area, or may not realize how important a market rent is, especially on this program where it's based solely off the market rent. We don't want that appraiser to just think of it as, oh, I'll just throw a market rent on there, no big deal. Well, it is a big deal on this type of program. So you can give the P&L from the Airbnb if the seller's willing to give it to you, to the appraiser, and say, hey, here's what it's been selling for on average in the last 12 months. This is straight from, Airbnb or VRBO or any platform like that. But what our borrower does with the property, if they choose to long-term rent it or Airbnb it, that's totally up to them. We're fine with that.
Excellent. Eric, pertaining to delayed financing, if a home was purchased a year ago on hard money, will it still qualify for delayed financing, or is it too long?
That's a great question. Delayed financing is up to 6 months. After 6 months, it's no longer considered a delayed financing.
Excellent.
Real quick, but with Angel Oak, we do allow new appraised value after 6 months, which is nice, where the industry, as you folks know, normally requires 12 months. We'll allow new appraised value after 6 months on a refi.
Excellent. We've gotten a couple questions about foreign nationals. If one of you want to touch on that real quick as part of this program?
Yeah, I will. Foreign national is basically based off the cash flow, the DSCR. Now, foreign national, in our definition, is somebody that lives in their country purchasing an investment property here in the United States. The great thing about our foreign national program, you do not need credit. You do not need a credit report. You do not need to build trade lines. You don't need reference letters. You don't need income. You don't need proof of where you occupy your primary residence in your country, meaning I don't have to ask for proof of rent or proof of mortgage. This is one of the easiest programs. The word foreign makes it a little scary for a lot of people. I get that. It's probably one of the most easiest programs that we have. The biggest caveats to this program is the DSCR coming in 1-to-1, covering my new mortgage payment. The other thing is the assets. The assets are going to be seasoned for a total of 60 days. Now, all of our other programs are only 30 days. So this one's going to be 60 days. You're talking about down payment, closing costs, and 12 months reserves. Now, your 12 months reserves, down payment, and closing costs do have to be transferred to a U.S. bank 30 days prior to closing. This is money laundering purposes. You will not have a foreign national borrower that balks about that. They totally understand that. So that does have to be moved to the U.S. 30 days prior to close. We have a lot of visa waiver program, or a lot of visa waiver countries, I should say, where they participate in the visa waiver program with the United States, Canada, Europe, Ireland, Germany. Those people don't even need a visa, just a valid passport. And we have information, if you guys have it, reach out to your AE. They can tell you which countries participate in the visa waiver. And on the other side too, which countries are sanctioned countries, which we will not lend on, like Venezuela, Iran, Iraq. So feel free to reach out for more information on that as well.
Excellent. Thank you, Stacy.
But folks, just real quick, think about that. All we need is a 1003. There's zero credit report, zero FICO score, zero housing history, not a zip. It's just fill out a 1003. That's it. Except don't put any income on it.
Excellent. So Eric, talk a little bit about where you can find these DSCR investor cash flow type borrowers.
Well, literally they are wherever anybody is right now, you have associations and you have investor groups, and people that own a lot of rental properties usually hang out with a lot of people who own a lot of rental properties. Guess who really knows where all those folks reside is probably good realtors. Good realtors know clients that have quite the portfolio of rental properties. Either they might want to cash out on some of those properties and buy more, or they have an appetite to want to buy more. So I think who really is the canary in the coal mine that knows what's going on there are great local realtors. Full stop. Now, hard money lenders, boy, wouldn't you love to have their database of all these people paying hard money rates when they qualify for this DSCR program? However, hard money lenders will never rate that mortgage to the credit bureaus. Why? If they did, you guys would just pick them off really easy. So hard money lenders that possibly they want to keep reallocating those assets, right? They want that 1 to 2 year balloon. Boy, they want another origination fee. However, they have borrowers that are now coming to them that are going, okay, I'm getting out of my hard money loan, and they might want to put that client into a DSCR loan so you can get them their hard money back. So talk to hard money lenders and let them know that you can take care of their runoff. They have the portfolio of them. And also just get the word out that you have access to this program, whether it be marketing flyers, whether it be social media. You guys, it really pays. The marketing you do today is going to affect your checking account 90 days from now. You want to get a pipeline full of loans? Literally start marketing today.
Excellent. Anything else, Stacy, on that?
Yep, I think Eric did a great job.
Okay. We're going to switch really quick now to some of our full doc programs. Stacy, you want to talk to us a little about our full doc, just missed prime jumbo?
Yeah, we have what's called our platinum. The platinum program is 4 years out of foreclosure, short sale. I know short sale and bankruptcy seasoning is not quite 7 years for conventional, but I know the foreclosure is. So if you do have somebody within the 7 years of the foreclosure, and also jumbo loans. The jumbo loans over your conventional guidelines now, we go up to 3 million. Owner-occ, second homes, non-owner-occs are all fine. Purchases, cash out refis, rate and term refis are all fine. And again, we only source and season our assets for 30 days. So if they do have somebody with mattress money or something that's not showing in the bank, get it in the bank now. We can go ahead and start the process, get it underwriting, and you don't have to submit that asset statement until closer to the end when you have the asset statement for 30 days that doesn't show the large deposit.
Excellent.
And one little caveat that I noticed that we don't list here, and folks, this is worth you being on this call right now. With Angel Oak, if it is a full doc loan, we literally only go off of the primary wage earner's FICO score. We'll allow the co-borrower's income, but we're only going off of your primary wage earner's FICO score. That in itself will save VA and FHA loans.
Excellent.
You only go off the primary wage earner's FICO score. Think about that one for a second.
Yeah, that's a good point. We also have a 1-year tax return program. If they've been self-employed for at least 2 years, we can use a 1-year tax return program. That's another one. I think Freddie's 5, you have to be self-employed for 5 years. So with ours, it's only 2 years. So that's another reason to be a just missed.
Excellent. So that was our Platinum program. Stacy, take us through our Portfolio Select program.
So our Portfolio Select is going to be somebody that maybe has had a recent hiccup in their credit. They can be somebody that's had a mortgage late in the last 12 months. We all know life happens. Things get in the way, people get sick, whatever the case may be, we understand that. It's a 1-year seasoning requirement on foreclosures, short sales, and deed in lieu. 2 years on a bankruptcy. If it's a Chapter 13, we can go off the file date to have that 2-year seasoning. As long as it was discharged and paid as agreed, we'll go off the file date. So if the file date was 2 years ago and it was just discharged yesterday, that's fine on a Chapter 13. And again, with this program, we go up to loans at $2.5 million, purchase, owner ox, cash out, non-owner ox, 50% back-end DTI, and also same with the 1-year tax returns available if you've been self-employed for 2 years. And again, like Eric said, we're going to use the primary wage earners mid-score. And we also have an ITIN program that's available under this product as well. That's somebody that has an ITIN number instead of a social security number. That person's going to be needing a 700 mid-score, 75 LTV. And that was going to also be a borrower that's going to be able to go full doc. This is a full doc program only, 2 years, or again, if you've been self-employed for 2 years, you can do the 1 year, but 2 years tax returns, W-2s, pay stubs.
Excellent.
Folks,
Eric, go ahead, Eric.
Everybody that's on this call is in a county somewhere. Every county has a county recording office. Anybody that has a bankruptcy, folks, is public data, meaning it's free. You don't have to go to a list broker. Why not go down to your county recorder's office and get a monthly list of people that have just been discharged on a Chapter 13 that had filed for it over 24 months ago. And these folks, lo and behold, are probably a lot of them homeowners. And we all know about all the equity people now have in their house. Wouldn't somebody one day out of a Chapter 13 that just literally was feast or famine paying off that bankruptcy, maybe, I'm just saying maybe, they might want to access some of that equity in their property. And nobody is talking to them except you with this program. Think about it.
Stacy, can you discuss a little bit more about the I-10 program? I had a couple questions about that.
Yeah, it's a full doc only, 75% LTV max. Again, they have an ITIN number instead of a social security. They don't need a visa. 700 mid score. This one is it will not qualify for the 1-year tax return. You do need 2 years tax returns, 2 years W-2s, 30 days of pay stubs. Is there a specific question on it?
No, I think it was just some basic information. The one that I've seen quite a bit is, can you use bank statements with the I-10 program?
No, it is a full doc only program.
Excellent, thank you. And Eric, let's hit on the last of our full doc programs here, asset qualifier.
Asset qualifier, we have an asset qualifier and an asset depletion. Let's talk about the asset qualifier. This is for somebody who's doing pretty well. They have a lot of assets. And I'm not talking about a car collection or jewelry. We're talking about investments, stocks, stuff like that, fairly liquid, right? They're doing well, or maybe they just sold their business and boy, they're now into a bunch of money and they want to go buy a $1 million home. Well, guess what? They sold their business. They're no longer employed. Now what? Well, right here, this is perfect for an asset qualifier loan because everybody understands you have to literally document somebody's ability to repay on their primary mortgage. And when you just sold your business and you no longer are employed, that makes it pretty tough to be ATR compliant. Income's this asset qualifier program, you guys. We have a calculator. If you have a borrower that does that just has a lot of assets but not a lot of income, come to your Angel Oak AE. We even have a little calculator that you put in the borrower's age, you put in the type of assets, and it lets you know if they qualify or not. It's again, don't overthink this stuff. Just contact your Angel Oak AE and we will walk you through this and all of our programs.
Excellent, thank you. So Stacy, tell us a little bit, I think some of these might overlap, but tell us maybe a little bit about where you can find these type of borrowers. And I know you have a tip on one of these.
Yeah, same thing as some of the other options of where to find these non-QM borrowers. Divorce attorneys is a good one. Divorce attorneys is going to be somebody, you're probably going to get 2 loans out of that one because somebody has to refi somebody off their house and somebody has to go buy a house. So that might be a twofer. Divorce attorneys, I think, is a really good person or really good business to definitely get some business from, definitely. The other one is, like Eric was mentioning before, on the bankruptcy attorneys. Again, a bankruptcy attorney is going to be somebody that can help you find these alt borrowers as well. They just went through a bankruptcy. Maybe they had to, bankrupt their house. Maybe they let that go. So those are another good contact for people to start triggering, trying to get business out of.
Excellent. All right, so we discussed delayed financing, condos. I know it's a big deal for you down in the Tampa area, Stacy. Talk to us a little bit about condos.
So all of our programs, we allow non-warrantable condos. There's many different reasons why a condo can be non-warrantable. Some we allow, some we don't. If you know that you're coming up on a non-warrantable condo, find out why. Yeah, ask the realtor. They usually know why it's non-warrantable. If it's new construction, that's something that we can do as long as 25% has been sold and closed. If it's open litigation, that's going to be a little bit trickier. Is the litigation against the developer? That's something we're not going to touch because you don't know how expensive that can end up being. If it's anything structural or safety reasons, missing railings, loose stairs, anything like that, safety hazards, we're not going to touch that. But if it's a small litigation, there was, a leak in a unit that dripped down to the unit below them, it has nothing to do with our unit, that's something that we're going to look at. So find out if somebody says, well, it's got open litigation, find out more information about that litigation. Non-warrantable condos are huge for us down here in Florida, especially up along the beaches. On the short-term rentals, we will allow short-term rental condos on our DSCR program, which is a huge, huge help for these condos because not a condo tels we still can't do. That's going to be where they have a rental desk. You walk in the door, or you can go right on their website, right on the hotel or condos website and book you and your family a room. That's going to be what we call a condo tel. Those we don't do. Some other non-warrantables, if it's 100% investor concentration, I'm fine with that. If the HOA has no reserves, which is very common, especially down in the South Florida area, I'm fine with that. So non-warrantable condos, again, huge. They also, Fannie and Freddie, have all those new questions on their condo questionnaire regarding assessments and deferments and the structural aspects of the condos. We don't ask any of those. Our condo questionnaire is very simple. It's not a limited questionnaire. It's a full questionnaire specific to Angel Oak, and it asks the questions that only we care about. So again, all these condos, I'm getting a lot of new business from condos that are no longer going conventional because of these new questions that conventional requires on their questionnaire. Either HOAs aren't wanting to fill them out or they're not answering them the way that Fannie and Freddie want them to be answered. We're getting a lot of that business. So if you have that, definitely reach out to your Angel Oak rep.
Just
You
one
want to
thing,
add
there's
something?
no hit to rate at Angel Oak if the condo is non-warrantable. There's no hit to rate. We don't pull out the cash register and go, exception, here's a rate hit, or that's going to cost you. Non-warrantable condo, oh, that's going to cost you. None of that here at Angel Oak. Not to mention the number one reason why a condominium complex is non-warrantable is because it exceeds 35% of the condos are rentals. We think that's kind of silly. We don't care if they're 100% rentals. I believe that actually adds to the value of the condo complex, like any condominium complex around a college campus. So we love the non-warrantable condos here.
Excellent. We're getting close on time here, so let's jump into the marketing portal. I'm going to log into that. Eric, you want to take us away on that or start talking about that while I log us in here?
Yeah, you guys, here it is. Your income 90 days from now is going to be affected by what you do today. We have a boatload of marketing for you. But here's a simple marketing flyer. I'm suggesting you take and go out and buy one of these. And I'm going to show you how this can make you $10,000. Huh? So you take said marketing flyer, you get them printed out, maybe keep 30 in your car. And as you're driving around in your typical life, maybe going to the gym, going to the store, anytime you pass a real estate office, pull into that parking lot, get out of your car, walk right into that real estate office, smile at the realtors, maybe drop your card, and take any flyer. So I like the bank statement flyer, and tape it onto the kitchen, onto the refrigerator in that real estate office's kitchen. If it's a smaller office, tape it to the cabinet right above their coffee bar. And you will start getting calls from real estate agents on your marketing flyers, especially the bank statement flyer. Just do it. The more you do it, the more calls from realtors you're going to get. Now, some of you might start thinking, I'm not really dressed appropriately to go into that office today, or oh, they have an in-house lender. I really can't do it to that real estate office. No, that's the liar in between your ears. And if you're really gritty, you'll take said flyer and you'll go tape it onto the back of the stall of the bathroom door that those realtors use. Get the word out that you can specialize in these type of loan programs, because you guys, it's time to get a little gritty, wouldn't you say? Now,
Excellent.
as you can see, Steve is on this bank statement loan, and anybody reach out to your Angel Oak AE and we will walk you through how to customize these flyers for you, including putting your picture on it, including your logo. And we have about 35 different type of flyers that we offer you guys. I'm telling you, folks, how you market today is going to affect your checking account 90 days from now.
Excellent. So we have flyers. Stacy, you want to talk about some of the other things? You want to talk about our presentations here?
Yeah, so we do have presentations that you guys can take with you. You customize them with your information, your logo, your information. Angel Oak's nowhere out there. And feel free to reach out to your AE to come along with you to do these presentations. If you're not comfortable, you don't know our programs as well, bring us with you. We're the experts on these programs. You guys have multiple lenders with multiple programs that you are supposed to know. So bring us with you and we'll be more than happy, whether it's person to person or Zoom. I do a lot of realtor presentations, and we're more than happy to help. And we're there as your advisor. We're there as your partner, not as Angel Oak. So I'm there to represent you. You're going to customize the presentation. You can get rid of slides that you don't feel fit your audience. We can try and add slides that you think you might want to have added, but again, it's going to be your contact information and your logo. So feel free to go through those as well.
Yep, I think we got a couple of questions about that. So I think that's the most powerful thing about the flyers, presentations, social media graphics, that here are social media graphics that you can use with copy as well. So none of these have the Angel Oak logo on it. None of these mention Angel Oak in the copy. They're all for you to use. The presentation, the flyers, you put your logo on it. So it's all stuff for you to have with branded to your own company.
And guys, this is all free to you. It's free marketing. We have the best marketing department of any company. I'm going to just put that out there. They do all this for you. Like, utilize it. All you got to do when you were in the flyers, you just literally plug in, click on up right logo, and you're going to drop in your right logo, left logo. I've had somebody put their favorite football teams as their right logo and their company name is their left logo. They wanted to make it fun and interacting. Put your photo on there. If your company requires a certain disclosure, you can put your own company's disclosure on there for your compliance, because maybe your compliance requires that. You can put your own disclosure on there. But as soon as you do that once on the left side, that's going to go to every single flyer that we have in there. So when you hit that drop down under select flyer and you want to change it to a foreign national flyer because you're going to go do a presentation with a foreign national realtor that you know does a lot of loans with Canadian borrowers or what have you. As soon as you enter it once, it populates to every single flyer. You literally print it out, take it with you, boom, you're done. We've done all the work for you. It costs you nothing.
Excellent. Yep. And or you can download it as a PDF to email out. It's up to you. So we got several questions on how to get credentials. You have to be an approved broker. Get with your account executive, and they'll get you the proper form for you to fill out to get access to the portal.
And reach out to your account executive here at Angel Oak, folks. We're going to walk you through best practices on these, on all the marketing that we offer you and exactly how to go about it. We have this figured out. I'm telling you, just reach out to your account executive. We're going to walk you through all this.
So Eric, what do you love to say most at the end? We love scenarios.
Listen, you guys, we do. We love scenarios. Literally, any broker check that ever hit your checking account all first started with a loan scenario. We are obsessed with loan scenarios. We literally, the wonkier, the better. And don't get discouraged when you come to us with a loan scenario, and it is a loan that is not fundable, because that's going to make you that much better at these non-agency lane and how to be more efficient at it. But it all starts with loan scenarios. Bring it on. We're here to make you money.
Excellent. So once Ken had a question, do we work as a broker or correspondent? You want to hit that, Eric, real quick?
Yeah, you can be both. We'll allow you to have both channels open. Non-delegated correspondent, where we do the underwriting, but you're doing the disclosing, you're drawing the docs, that's fine. Or you can choose to be a broker with us, and we're going to disclose. We're going to obviously underwrite, and we're going to doc the loan for you. You can have either channel open or both.
Excellent. All right, well, we're over time now. So Stacy, you want to give us some final thoughts?
I would just say, guys, don't ever pass up on a loan. Say you can't do it without reaching out to an account rep first. You know, if it doesn't fit Fannie or Freddie, doesn't fit that vanilla, don't be scared to try non-QM. They're actually very easy to do. We will help you, walk you through every step of the way. So don't ever turn down a borrower without calling your Angel Oak rep first.
Final thoughts, Eric?
You guys, give us scenarios. Reach out to us.
Excellent. So one final thing, when we end this webinar, a survey will pop up. If you wouldn't mind taking a minute and answering a few questions about how we did here today. And second, please follow us on social media. It's a great way, in addition to keeping in contact with your account executive, to learn about updates to our programs, different tips and tricks on what other loan officers are doing to sell non-QM. We're on LinkedIn, we're on Facebook, and we're on Instagram. So with all that, thanks everybody for attending this webinar today. And if you have any questions, like Eric and Stacy said, please reach out to your account executive. They'll be happy to help. Thanks, everybody.
Thank you.
Thanks, Stacy. Thank you all.
Take care.